Welcome. Thank you for coming to our third of four biannual tax workshops put on by the Joint Fiscal Office and hosted by the Ways and Means Committee. Today, we're going to talk about consumption taxes, something that apparently I think both of these folks here think we don't talk about enough. And so really glad you're all here for the conversation. Thanks for spending your lunch with us.
Good afternoon, everybody. My name is Kirby Keaton. I work for the Office of Legislative Counsel and I handle the tax portfolio.
I'm Ted Barnett at the Joint Fiscal Office. I do consumption taxes, unsurprisingly, and kind of random bits and pieces on the revenue side that don't have a home otherwise.
All right, and with that, we're going to give you the crash course. I'm going to go first. I'll talk mostly about our sales and use tax and our meals and rooms tax, which are the two big consumption taxes that Vermont has, big being revenue-wise. We'll talk about the structure of those taxes. We'll talk about some history related to the sales tax and some federal judicial decisions that have influenced what Vermont's been able to do in the past. We'll talk about the issue of marketplace facilitators and also some other recent updates with consumption taxes. So to start us off on the basics, the tax base for the sales and use tax, which is what we'll talk about first, is retail sales of tangible personal property. And then there's some other enumerated products or items that the sales tax is applied to also. One thing to know about the sales tax is that there's many exemptions for the sales tax in Vermont. It's a pretty complex area of the tax code because we have more than 50, I think maybe more than 60 sales and use tax exemptions. Some of them are simple and straightforward, things that even if we didn't have an exemption, we'd have to do, such as we can't make the federal government pay sales tax, or we can't impose a sales tax on the state itself. But then others can be quite complicated and requires taxpayers to learn a lot about how to qualify for them. The tax rate for the sales tax in Vermont is 6%. In some places, there's a 1% local option tax for some municipalities, in addition to that 6%. And the tax liability for the sales tax and also for the meals and rooms tax is on the buyer in that case. So when an exemption is used, that would be an exemption based on the buyer not paying the tax. We're not going to get into the weeds a lot, but one kind of weedy issue to know about sales tax is that it's on retail sales, which becomes important. It's not on wholesale. It's not on, in legal terms, it's sales for resale. And that can become important when this tax is administered. Just to give you an example, a grocery store might buy paper towels to put on the shelves to sell, right? And that when the grocery store is buying those paper towels, it's not paying sales tax. That's for resale. They're buying it at wholesale, not subject to sales tax. But if the grocery store were to take those paper towels off the shelf and use them instead of selling them at retail, they become the user, and then they owe sales and use tax for that use. So that's one small example of how the concept of buying things for resale can become complicated, because you can think it's for resale and then it ends up being some other use.
A question about that?
Okay.
That to be purchased from a wholesaler, if you will. I'm thinking of this example. I can go to Costco, buy a box of granola bars. Person behind me may be buying 15 boxes of granola bars because they have a convenience store and they're going to sell them. Are we treated differently, or is it because of the location where we buy it, we're both taxed? And that's maybe a bad example because it's food, but
yeah. The difference is if you're purchasing something for resale, you'll use a resale exemption certificate. That's how Vermont tracks that. Whether Costco accepts resale exemption certificates, I actually don't know. But that is how a retailer, when they're buying for resale and not paying sales tax, that's what they do. So moving on. So the sales tax is collected by the seller, as we said, and is held in trust on behalf of the state when it does that. So we're talking about consumption taxes for this presentation, but we could easily call this trust taxes also. That's another tax jargon term that's used in this area. A trust tax is one where the seller is collecting it, holding it. It's not their money. It is illegal for them to use it for any other purpose. They are to remit it to the state periodically when they file a return with the Department of Taxes. So consumption taxes, trust taxes, not always the same thing, but in a lot of cases are the same thing. As we've already said, sales tax is paid on retail sales, not on wholesale. And then there's it's called the sales and use tax because the use tax component of it is very important. Use tax comes into play. It's important because without it, we would have major loopholes in the sales tax. For instance, if a Vermont resident goes to New Hampshire to buy tangible personal property that would be subject to tax in Vermont, brings it back to Vermont to use it, that is actually subject to sales tax in Vermont. Its use is in Vermont. So if not for the use tax, that person could avoid paying sales and use tax in Vermont. It comes into play the example I used before with the paper towels thing, where a resale exemption was used, but then the product gets used for some other reason. Use tax is what specifically comes into play there to make sure that we don't have tax avoidance built into our system. Use tax also would come into play. We'll get into this later in the presentation, but before Vermont was able to have online retailers collect sales tax, that had to do with the collection responsibility and did not have to do with whether sales and use tax was actually applicable. Before changes were made in 2018, between 2016 and 2018, before those changes were made, Vermonters who bought things online would not have to pay the online retailer necessarily sales tax, but they would still owe the use tax for those things. The problem, of course, is Vermont was not getting that money. It was not, the use tax was not being paid. It wasn't making it to the state for the most part. So that's the use tax. And I already mentioned the local option tax, so we'll keep moving on that. So here's a segue. We were just talking about remote sellers. One area of law that comes into play with the sales tax is the U.S. Constitution, specifically the Commerce Clause. So the Commerce Clause prevents states from doing a couple of things. One, discriminating against interstate commerce, and another is to impose undue burdens on interstate commerce. Something that Vermont could not do, something the General Assembly here could not do, or if we did do it, we would lose in court, would be to say that if you want to drive through Vermont, if you're a Vermont resident, you can do it for free. But if your license plate is some other state, you have to pay us some money. Interstate commerce relies on those roads to flow through. So that would not be constitutional. We're putting an undue burden on interstate commerce in that case. And it's one that's discriminatory against interstate commerce, but it would not be discriminatory against Vermonters, right? So that's the kind of thing that we have to avoid. So back in 1992, when I was 11 and going to watch Wayne's World, the U.S. Supreme Court was busy interpreting sales and use tax in the context of mail order, catalog type transactions where a business was based in, say, out west somewhere and making sales to an East Coast state, or in this case, specifically it was North Dakota. And the question was requiring those sellers who were based in other states to collect sales tax. Is that an undue burden on interstate commerce? This was right before the internet showed up. They were thinking about just catalogs. They were thinking about a much smaller scale form of commerce when they decided this case. And the Supreme Court decided, yes, it is an undue burden to have those retailers collect sales tax. And that meant when internet sales started to blow up, that states have had a major problem with sales tax compliance because they weren't able to make a lot of online sales or online retailers collect that sales tax. But the brick and mortar retailers that were located in the states would still have to do that. And so there was a lot of disadvantage with local sales compared with national retailers. And that was all the way up to 2018 when South Dakota decided to directly challenge that Quill decision, that earlier Supreme Court decision, deliberately creating a requirement that online retailers collect sales tax. But at the same time, South Dakota built in some requirements so that not all online retailers had to. It was just those that had more than $100,000 of sales into the state or made 200 or more individual transactions into the state. So it's aimed at larger scale business with the idea of thinking that if they're that large and they're doing that much business, then it should not be considered an undue burden. So this Wayfair decision, as it's called, required South Dakota having a lot of legal advice and a lot of preparation to prepare to take down this Quill decision, and they were successful. The U.S. Supreme Court agreed and stated that with these requirements in place, that South Dakota's requirement was fine and it was constitutional. And they stated, you see on the slide there, that the Quill decision was incorrect and unsound. But really, I mean, what really was going on was they weren't able to see the future, to see that the internet was going to become so important to commerce. So those requirements I was talking about are called an economic presence test. Vermont has a similar economic presence test. South Dakota was part of what's called the Streamlined Sales and Use Tax Agreement. Vermont is also part of the Streamlined Sales and Use Tax Agreement. That is an organization that works with states to try to make sales tax consistent across the board, across those states, so that businesses know how to comply. The idea is to make it easier for taxpayers to comply with all the various types of laws that are across all the states, trying to bring consistency across the country. That was mentioned in the Wayfair decision. The importance of that streamline agreement was mentioned. So that brings us to Vermont. We prepared for it. We have a similar law as what South Dakota had with the economic presence requirements. Vermont the General Assembly here had put laws into place that were ready to go as soon as something like Wayfair happened. And becoming effective July 1st, 2018, large online retailers started having to collect sales tax for Vermont. There was also the issue of marketplace facilitators, which is a wrinkle. That is like your websites that have multiple different retailers or sellers working through them. I don't want to name any, but I think you can maybe think of some where you go to that website, but you're not actually buying the product that you're clicking on and purchasing from them directly. It's some other seller there. So in a nutshell, our law also captures the facilitators, the websites that do that with third-party sellers. Okay. Some other recent changes, and we're almost done with sales tax. Hitting the big stuff. Was that for a long time now, pre-written software has been subject to sales tax in Vermont. It's considered it's one of those things that are called out as specifically taxable. But in 2015, the General Assembly put into some session law that pre-written software accessed remotely would not be subject to tax. And that was I believe to try to make it easier on online businesses that were starting to grow at that time and to give them some favorable tax treatment. So up until last year, if you downloaded software, such as even streaming it's technically a download of software. If you downloaded a web browser, or if you bought a media like a CD to install software, all of that would have been subject to sales tax already. But what wasn't taxable under the session law was when you pay to use software, but you're not downloading it. Instead, you are logging into the system of some company and using the software that's actually located on some server somewhere. And so that's what access remotely means in this context. And that was not taxable. After Act 183 of last year, it is now taxable. The old session law that prevented that from being taxable was repealed last session. So now sales tax does apply to instances where you pay to log on to and access software through the internet. And that's just the language that I was just talking about. The underlined part was what was added last session. Okay, and I think I already mentioned this, but just so you have some awareness about this issue, because it's come up in recent years, what's taxable, what's not when it comes to software accessed remotely. The things that are not taxable as of right now are custom software. If a business hires another business to design some unique specific software just for them, that is more akin to when you go to an attorney and you ask them to make a will for you. You are technically getting some tangible personal property out of that. You're getting a will, but what you're really paying for is the service. That's what the custom like that kind of logic is why custom software would not be considered taxable. Digital photos, if you purchase those, they're not considered taxable. And any kind of IT type services, support services are not taxable because, again, those are considered more like services. And Vermont does not impose sales and use tax on services at this point. Some states do, so you're aware of that. That brings us to meals and rooms tax. And I've got to give Ted some time, so I've got to really speed it up here. The tax base is, a lot of the concepts are similar to the sales and use tax, except that for meals and rooms, it's imposed on occupancy, rent, and taxable meals. There are many exemptions here too, not as many as the sales tax though. There's a flat rate for meals and rooms of 9% at the state level. Also, there's a local option tax in some places for some of these things. And the tax liability is, again, it's on the buyer, either the occupant renting a room or the person purchasing a meal. We'll talk about meals tax first. Nope, we'll talk about rooms tax first, apparently, or both. Okay, I already said about the occupant and the purchaser. The tax is collected, again, just like sales tax. The business itself is collecting that money. It's held in trust for the state. It's not their money. Now we'll talk about meals. General rule with meals tax is if you're considered a restaurant under the law, then all food and beverage sold subject to meals tax. That's straightforward. If a business is not a restaurant, there starts to become questions about whether certain items are taxable or not under the meals tax. So usually this is going to come up in the context of grocery stores or convenience stores. There's certain things that are always going to be taxable. Sandwiches, unless they're frozen sandwiches, are considered, those are for immediate consumption. Even if you buy a sandwich at a convenience store, it's going to be subject to meals tax. Salad bars, heated food and beverages, vending machines, all that stuff's subject to meals tax. But groceries that are prepackaged, those are not. And they're also not subject to sales tax because we have a sales tax exemption for food. Okay, now we'll jump into rooms tax. This obvious rooms tax is due on the rent charged for the use and possession of sleeping accommodations. It does not apply to the rental of a room for 30 consecutive days or more, at that point, you're a tenant. You're not, this isn't a short-term stay anymore. This is not subject to rooms tax. And then other situations like summer camps for children and some employee-employer situations. Those are things that are not considered occupancies. As I mentioned before, the terminology in the law is the business that's offering lodging is called an operator. And operators include hotels, and then hotels are defined. It's a very broad definition. And then we'll get into some recent changes, and we'll be done here. So I mentioned, how things have gone down since the 90s for sales tax. There's been some things in meals and rooms tax that have happened more recently. One thing that came about that Vermont had to deal with was short-term rentals and how to treat those. The law wasn't written for that, so it required some adjustments. There were some deals made around 2016 to try to get some short-term rentals operators to collect. At that point, it wasn't clear whether they were operators, so that's why it was kind of a gray area at the time. I did happen to work on the deal that was made in 2016 to try to get some of that revenue for Vermont. But by 2018, it was put into the law and it was clarified. Short-term rentals are subject to rooms tax now. And there's not any more ambiguity with that. Another question that came up recently was online travel agents, those websites that you go to book your trip, but they're not actually the airline. They're not actually the hotel. There was questions about what their responsibilities were. So we've clarified that by now, and that they are going to be considered operators and they do have to collect the tax. More recently in 2021, there was meal facilitators. If you think about the websites that offer to do meal delivery for you, but they're not actually the restaurant themselves, that's had to be clarified in recent years. Yeah.
The question about the online websites that are operators, but as a Vermonter, they would only need to collect a tax for Vermont if I'm staying in a Vermont hotel. If I go down to Brattleboro and stay in a motel that collects something that Vermont gets. If I'm getting a hotel in Boston.
That's correct.
Vermont's not involved.
That's correct.
Okay.
Yeah. And I think this is our last slide. As of last session, there was something new that was added. There's now a short-term rental surcharge that's applied in addition to the rooms tax on short-term rentals. It's a 3% surcharge, and all of that revenue is going to the education fund. And that was something from last session. And that's it for me.
Yeah, so to pivot into the fiscal side of consumption taxes, and some of the information will certainly sound familiar because it's a repetition of what Kirby has talked about. Great. So first, want to place consumption taxes within the broad scope of revenue that's collected by the state of Vermont. This bar graph shows the amount of revenue from property taxes, income taxes, consumption taxes, and fees. And you'll see that consumption taxes overall in that broad bin is $1.34 billion estimated in fiscal year 25. That's about 26% of overall revenue collection by the state. So yes, when we're talking about that $1.34 billion slice, what does that include? It includes sales and use tax, meals and rooms, our motor vehicle purchase and use tax, excise taxes, which are broadly speaking taxes on specific goods, such as tobacco or cannabis, There's healthcare taxes, which my colleague Nolan Langweil at JFO works on. And then there are a whole host of other taxes. There's fuel taxes or solar energy capacity taxes. But in this presentation, I'm primarily going to be talking about sales and use in meals and rooms. Consumption taxes have considerable nexus with the education fund. This table is from the January 2025 consensus revenue forecast. And 100% of sales and use tax, 25% of meals and rooms, and a third of motor vehicle purchase and use tax flow to the education fund. So you can see in fiscal year 25, sales and use is going to deliver over $600 million to the education fund. And to place that similarly within the broad scope of the education fund, sales and use tax is 26% of overall revenues. Meals and rooms, it's 1/4 of the total of meals and rooms that goes to the education fund, is 3% of overall education fund revenues. And then purchase of use is 2%. So a considerable portion of the education fund comes from consumption taxes. You'll notice that when talking about the education fund, I did not mention cannabis taxes. We get asked this quite a bit at JFO. There are two taxes that are levied on cannabis. There's the 14% excise tax, which goes to the general fund, and then the 6% sales tax is allocated in statute to after-school programming through the Universal After School Special Fund. Also, for a sense of magnitude on cannabis taxes, in fiscal year 25, it's estimated to generate 20.8 million, and 30% of that is earmarked for substance misuse. And the sales tax is for after-school programming is about $9 million in fiscal year 25 and 26. So just a piece about cannabis, a slight discursion to probably provide some scope because it's a relatively new tax and it generates a lot of interest. To review some of the things that Kirby talked about in his presentation, sales and use tax is 6% on all tangible personal property. The definition of tangible personal property, things that can be seen, weighed, measured, felt, or touched, received by the census. Kirby did go over the exemption on pre-written software access remotely. The sales tax is paid by the purchaser on retail sales. And the use tax is due on purchases that would be subject to the sales tax, but was not otherwise paid. So sales taxes, unsurprisingly, are kind of subject to broader economic trends. So one piece is talking about historically, going way back to the 1950s and 60s, much more of the US economy was comprised of goods purchases as opposed to services. So this is what's shown on this chart. You have the green line, which is services, about 25% of the economy in 1950, but by the getting to the current day, it's over 45%. And you've seen purchases of non-durable goods decrease pretty dramatically. And this is important because sales taxes apply to goods purchases and not services. And you can see a little blip, a little uptick in durable goods purchases right after COVID. We were all sitting inside looking at the couch and determining that we didn't really like the couch, so we're going to buy a new couch. So it provided right after COVID certainly a little boost to sales tax revenue collection. The other piece is that all else equal, if there's high rates of inflation, you're going to see sales tax revenue increase, right? Because it's 6% of the purchase price. And so in this post-COVID spike in inflation, that was certainly driving nominal increases in sales tax revenue. And I talked about nominal, which means that the actual dollars that are being collected. And it's helpful to compare nominal and real, which is adjusted for inflation sales tax revenues. And when you're looking at nominal sales tax revenues, you may miss some of the underlying trends. So when you show real sales tax collection in a long time series progression, you can kind of isolate, as you can see here, a decrease in sales tax kind of consumption that occurred during the Great Recession. And then you can see the uptick in sales that occurred after COVID. And when you're looking at nominal, you could see this increase after COVID that, you know, is comprised of both an increase in like goods purchases, as I mentioned, but also an increase in inflation. Pivoting to meals and rooms, 9% on meals and rooms, 10% on alcohol. The revenues are split between three funds. So this was effective in first effective in fiscal year 2020. 69% of meals and rooms tax goes to the general fund, 25% education fund, and 6% clean water fund. And as Kirby talked about, our new piece around short-term rentals and the 3% surcharge, which is 100% allocated to the education fund. The July 2024 revenue forecast estimated $8.6 million in new revenue in fiscal year 25. It's a new tax type. So we'll see if it gets to that amount, but that's what was estimated at the beginning of the fiscal year. And similarly, there's a picture that there are two different pictures that you can draw between nominal and real meals and rooms tax collection. The main piece that you can really see both in both metrics is the decrease in meals and rooms tax revenue collection right after COVID. We were all at home, weren't able to travel, weren't able to go to restaurants, and that really hit meals and rooms tax collections. However, you can see that once the economy opened back up, those revenues responded. Local option taxes. Municipalities can do a 1% local option on the sales tax, meals and rooms tax. It does apply to cannabis sales taxes. And those revenues from local option tax, municipalities keep 70% of those revenues. And 30% goes to the pilot special fund, which pilot stands for payment in lieu of taxes. And it compensates municipalities for the value of state-owned buildings that are within their borders they wouldn't otherwise receive tax revenue for. And last year there was a change that allowed municipalities to implement a local option tax without having to do a charter change. So that's new, and yes, gives towns a slightly easier way to implement a law. For those who are here for Chris's initial 6 principles of a high quality tax system, I'm going to follow that lead and talk about how some of those principles apply to consumption taxes, primarily through the 3 main questions. 1, is the system fair? 2, how simple is the system to understand and administer? So really getting at that simplicity piece. And then finally, how do people respond to changes or in the tax and consumption tax structure, or how do they respond to where how consumption taxes currently operate? So broadly speaking, consumption taxes are regressive. That is because younger or lower income households spend a greater share of their income on goods. So you can see this is from the ITEP report, but it shows that folks who are in the lowest 20% of kind of the income distribution spend nearly 6% of the family income. That comes from sale, or yes, is 6% of their income is sales and excise taxes. And then by the time you get to kind of the top 1%, it's less than 1% of family income is taken up by sales and excise taxes. And yes, so the rates also, there's a flat, unlike the personal income tax rate, there's a flat rate. It's 6% regardless of your income, pay the 6% sales tax. Within that broad scope, choices have been made to exempt certain goods from the sales tax to make the system more equitable. So groceries, clothing, medical products, those have exemptions from the sales tax. And this is designed to lessen the burden on folks who are maybe at lower ends of the income distribution. But there are also choices that have been made to exempt certain goods for a variety of reasons. For example, agricultural fuels and inputs, right, to support the agricultural industry, advanced wood boilers to support those technologies for fuel efficiency. And as you get more of these exemptions, right, you're losing a piece of simplicity. Each exemption, the Department of Taxes they make jurisdictional opinions, right? They're trying to figure out who the exemptions apply to, which products. And so as you're contemplating more exemptions to make the system more fair, you may be losing simplicity. So there's a bit of this trade-off. JFO, together with the Department of Taxes every 2 years, categorizes or catalogs all of the tax exemptions in existence, and sales consumption taxes are included in this. Sales in meals and rooms tax. It's published every 2 years from the most recent 2025 report. As Kirby mentioned, there are a lot of exemptions and an estimated large share of kind of exempted revenue from the sales and use tax. So that's estimated at $380.1 million in fiscal year 26. And on the meals and room side, it's a much lower share and estimated at $9.6 million in fiscal year 26. So within the sales tax, sales of food and groceries, that exemption is by far the largest at $143.4 million. Energy purchases is another large exemption, clothing and footwear, agricultural inputs. So this tree map is showing of that kind of share the largest exemptions, and then all others make up $48 million in exempted value. So diving a bit more into the simplicity piece, the definitions of really matter for consumption taxes. So talking about a meal versus tax exempt food, and this is certainly more of Kirby's world, but wanted to talk about how complex some of these things can get. For example, alcoholic beverages. One case that was brought up a couple of years ago, right, is if you go to a brewery and you ask for a pint from the bar, that's subject to the alcohol part of the meals and rooms tax, the 10% tax. But if you purchase a growler for at-home consumption, that's differently treated. A contractor purchasing materials, should that be considered an input versus, someone who's doing that work on their home? These decisions and definitions can get quite complicated. And I borrowed this from the Department of Taxes, where they talk about what's exempt clothing versus taxable clothing accessories. And so, coats and jackets are exempt, but briefcases are taxable. Neckties are exempt, but wallets are a clothing accessory. So this really shows kind of the various pieces and how complex it can get. And then the final piece, how do people respond to a tax structure? The principle of tax neutrality is really getting at, if you're following this principle, the tax system is minimizing unintended consequences. The sales and use tax rate is likely to influence behavior, particularly in Vermont, because our neighbor in New Hampshire doesn't charge a sales tax. So retailers may decide to locate on one side of the river versus another because, the consumers who purchase from them in New Hampshire don't pay any sales tax, but if you locate on the Vermont side, there is the sales tax. And you know, how far are people driving who live close enough to New Hampshire to avoid the sales tax? And there was a excise tax of 1.5 cents per ounce of soda in Philadelphia, and research found that that decreased both sales and consumption of soda. And a final piece, researchers found that higher local sales taxes potentially decreased housing prices. So there are all these secondary effects that happen when, in response to a specific tax structure. Another closely related piece is looking at economic competitiveness. So how Vermont's rates compared to neighbors. These tables show New England states with both their sales tax rates, and another table that shows meals and rooms tax rates. And you can see Vermont is on the sales tax side, 6%, Rhode Island, 7%. There's within the sales tax structure, there's Vermont is pretty comparable to neighbors. There's more variation in the rooms tax, and would like to highlight that these comparisons don't include local taxes, and particularly on the lodging and the rooms tax side. Cities and local jurisdictions may charge much higher lodging tax rates. If you've ever gotten a hotel in New York City, certainly experienced that. And on the sales tax side, although the rates may look very similar, there are different bases, right? Different states are exempting different goods, particularly on the clothing side. Different states have different thresholds for exemptions. And so when you're comparing Vermont's economic competitiveness on the sales tax side, that's also a piece, is the rate and the base. And that is it on my end. Yes.
The graph you showed that showed the cost of the sales exemptions, the tax expenditures. Didn't have a category for services. If they were included in the green other box, or if they were not included.
We wouldn't consider that part of the tax base in the first place because it's not taxable. So it's just, it was just excluded.
Thank you. I have another question if no one else does.
Sure.
The 14% excise tax on cannabis collected at the point of sale along with the 6% sales tax?
That is exactly right. Yep.
And there's another hearing in this room in 5 minutes, so folks have one more question, that's great, and if not, we will. Okay. Look at all that. Thank you both so much.